How's it, everyone? If you're new to the channel, welcome. If you're returning subby, welcome back. If you're returning watcher that isn't a subby, please subscribe. Okay, so I don't know if you know, but I've got a property model that a good friend of mine, Duzi, created for me years ago. And I've made some modifications to it over the years. And it's my first port of call when I get thinking about an investment property, but like I'm going to take you through it step by step and fill in the numbers so that you can do the same thing for your investment case. First thing we're going to property 24. There's a listing that I like. It's a 2-bedroom apartment in Claremont, Cape Town. To give you context, Claremont is super close to UCT. The UCT bus or the Jammy goes through or passes through Claremont, and it's super close to a lot of asset management companies, which means there's a lot of young professionals renting in that area, because a lot of asset managers are concentrated in that area. It's close to a lot of private and really solid public schools, which means you've got a lot of teachers living in the area so that they can be close to that. In terms of UCT, lecturers also like the area, so it's pumping. So 2-bed, 1.45 million. It's big. It's a big apartment. It's an older development. The balcony is quite nice. The grounds are nice, well kept. You like to see that. Nice hardwood floors. Wardrobe a bit old, but lots of cupboard space. There's an ensuite situation going on, it looks like. Then there's a full bath. I might be lying about the ensuite. The kitchen is outdated, but like I said, students, young professionals, they can't really be picky. Right, more of the grounds. Right. So complex is waste large. You can obviously pull the property report, even if you don't have the exact unit number, just to get a feel. I didn't, because if I were to do that, I think it would reveal my email address or something. So I just didn't do that. But we've got the numbers here in any event, and we'll put in the appropriate, percentage discounts and all of that. You've got the size, it's 89 square meters. That's massive. That's massive, even by Joburg standards. Like, we're looking in Claremont, Cape Town, but even by Joburg standards, 89 squares for a 2-bed is generous, right? Let me see what that works out to. So 1450 divided by 89. That's 16,000 a square meter. That's not bad. The rate's about 690, so that's you and City of Cape Town. That's sewage, and that's actually, it doesn't include sewage, but it does probably include waste removal. And then levies, that 1.7 might include sewage. That's the thing. You want to get the agent to send you the financials and the latest rates and levy statement so that you can actually see what's what. Do you get me? Just to be safe. So you've got Susie Norton. She's the one that's listed that. There's what I was trying to calculate, the price per square meter. So it's showing recent listing, so fairly new. And then you've got the levies, you've got the rates, and then there's the big numbers, right? Cool. So let's say I like this. What do I do now, right? First of all, first thing you do is you want to plug in the numbers. So I go to my numbers, and then I don't want to do like a side-by-side situation because it's just going to confuse things. So I'm going to put the market value as 1,450. We're taking that as assumed. You'll obviously want to do your own research on that, but like for now, we're gonna take that as assumed. I've got the 1,450 over there. My offer price is going to be 90% of that. Let me say I'm gonna offer 1,305. Why? I'm putting a 10% deposit. I'm putting a 10% deposit because on an F&B report, F&B shows that nationally there's about a 9% discount, or people typically offer 90% of the ask price. I mean, Claremont, Cape Town, high demand, so you may not get what you want, or they might push back and get for 95, or your offer might be competing with others. But as a rental income investor, you don't want to be desperate. If you've put 90 in your model and 90 works for you, put in that offer. If they don't like it, push away. If you offer 85 and they push, then you can go to 90. And if they take that, perfect. Do you understand what I'm saying? But I'm going to do 90 for the purposes of this exercise. So this I'm going to leave at that, but I'm going to change it now. So I'm putting this as blue because we filled that in. We're comfortable with it. We're going to put a 0 deposit. We don't have money. We're just girls. Actually, let me put 1 because there's a metric here that needs the deposit to be non-zero. And then it calculates the transfer costs. And then I've got to put that as the maximum of 0 or all costs, simply because for new developments, you wouldn't pay this money, right? Let's say there's no upfront costs. I'll put a 10,000 refurb cost, but I'll put that as 0 for now, right? Levies, they've given us, I've got a lot open here. Okay. Levies, they've given us as 1703. Levies, 1703. Rates, I think they were about, 689. That's perfect. Allowance for bad debts is basically a percentage of the rental amount, which we're also going to look at. 7,000 is way too low for Claremont, right? So it's already populating the bond and the annual rental yield that you're going to get, but we're not done. It's still early days. Happy with repairs and maintenance at 5%. Happy with property management at 5%. Although they might want a bit more. Some rental agencies want 10%. It's ridiculous out there. Lease window, I've put a 0, but I did put a vacancy of 1/12 simply because it's very studenty, like I said. So they might want a 10 or 11-month lease. So you just want to leave that flexibility in your model. And then bond interest rate, I'm just going to put that at prime. I'm being generous even there. Rental growth year on year, I'm going to look at Stats SA for this. So this is going to be quite interesting because I don't want to give you numbers that are thumbs up, right? These numbers, we get them from somewhere. So I just want to show you that. Same thing with this appreciation year on year. So rental growth, I don't know if we're going to find on Stats SA, but I know appreciation. That's the P0160, which I've already pulled. And then sales price at exit is going to be informed by that. Cost of sales also quite generous. I'm going to actually put it at 5.5. I'm busy with a disposal of an asset myself, and they charge me 5.5, which I think is pretty fair, but it can get higher is what I'm trying to say. So I want to be as realistic as possible. Building insurance is 0 because that's in the levies because it's a sectional title. Okay, right. So now what I'm going to do is I'm going to go and try and find out this number, the rental amount. It's a 2-bedroom. It's Claremont, Cape Town. We're not going to overthink it. We're just going to go on the same property 24 and we're going to say back to results. We're still in Claremont, but now we're going to say to rent. We're going to keep it a 2-bedroom apartment and we're going to keep it an apartment. And we're going to search by the latest, right? First of all, you can see it's scarce, 1 of 8, right? I don't think this company is real, but don't hold me on that. 3-bedroom is 19,000. There's a 3-bedroom listed by owner for 40,000. There's a 2-bedroom for 22, and then there's another 2-bedroom, but that's Harfield Village. That's just past. If you use the train, you'll know Harfield, I think, is just after Claremont, or is that Heathfield? I don't know, but it's not really Claremont. It just looks, or it's better for the company to put it under Claremont, I guess. And then you've got a 3-bed. We'll look at a couple. I mean, we're already here. Let's look at this 2-bed. Where's another 2-bed? Let's look at this one. We're not going to bother that at 8.6 because that thing has been listed for ages and that company, I'm going to keep it at that. Right. So let's look at the 2-bed for 22K. This is what you're competing with, right? This is what's listed. This is what, if I'm a student, I'm a young professional, I'm looking for an apartment, this is what I'm looking at relative to your apartment, right? This is 22K per month. So probably 2 young professionals, 11K each. We're just going to see if it's, what's her name, or not. If it is furnished or not. Let's see the name of the complex. Steps away from Cavendish. I think I know it. I think it's on that corner. Admin fee 860 available from May to September 2025. So it's a short-term lease. Interesting. Fully furnished. Okay, that makes sense. Very nice. So that's competition number 1, right? But again, we're just looking to see the numbers. I don't think we're going to be able to match up with this. This is giving hotel vibes and it's fully furnished. This is the second one, which is going for 19,000. Ooh, this is gorgeous. This is, and a balcony. Oh, it's so nice. Ensuite, it's to nice. It's to die for. It's to die for. Okay, so 19, let's see, is it furnished or not? Secure parking you have to pay for. There's an application fee. There's a drafting fee. Oh, they're mad. There's a tenant charge of that. Deposit requirements. I don't know. Furnished? No. So it's unfurnished. So unfurnished, 19,000. That's 3 beds. So we're going to say 19 divided by 3 divided by 3 times 2, 13. We're going to do 13 for our purposes, which I think is quite low for Claremont, but for the purposes of our, I guess, exercise, we've got a number. So we'll do 13. Right. So now we've got 13,000 that we've put in. We've got our levies, we've got our rates. Let me just make everything blue that we're comfortable with. Right. Okay. So yeah, we're comfortable with that. We're comfortable with this. Comfortable with cost of sale. Okay, so I think this is what I want from Stats SA, right? Before we get into the meat of things. So now I'm going to go to Stats SA, right? And I'm going to say, so you go to Stats SA, so you Google Stats SA, right? You go to publications, statistical publications, and then here you start searching, right? So that's what I did, and that's why I'm here. So I know that the report is the P0160 report. The latest one is 13 March 2025, and it's 6 months back, so it speaks to October period. We're going to take the latest one, and we're going to run with that. I don't want to overthink this. I'm literally just waiting for my, my coffee machine to finish. So I don't want to do too much. So it speaks about the residential property price index, national and provincial indices, which is what we want. So these are key findings. You can read that in your own time. What I'm interested in is Cape Town specifically. So this is at a provincial level. Cape Town weights 34%, Gauteng weights 40% of the index. So it tells you how big they are relative to the rest of the country in terms of rentals. So they together are about 75%. So if rent falls in Gauteng and in the Western Cape, nationally, rent should come down, right? But if Cape Town or if Western Cape and Gauteng go up, then nationally, that's what the contributions sort of mean over there. Then they've got the indexes here. We're interested in the percentage changes, right? So Western Cape went up 0.6, and then month on month, and then year on year, 7%, right? Gauteng, 0.5 month on month, annually 2.2%. Can you see the vast difference? The Eastern Cape is also doing quite well, but we're gonna try and see if we can get it at a city level because Western Cape is quite big. That is such a blurry, ugly chart. Let's see. That's provincial. Okay, now you've got the metros, right? So Cape Town Western Cape was 6.9, and then City of Cape Town is 6.2. So that's what we want. We want the year-on-year number. City of Joburg is 2.1. I own property there. Ekurhuleni is 0.3. I own property there. It's sad to look at. Nelson Mandela Bay is what's bringing Gqeberha up at 5.6. So that's what's bringing Gqeberha up, and then Emondi, it's up because Buffalo City is up. So we're going to take this number. That's what we wanted. I've shown you how to get it. Now it's up to you. So I'm going to go and I'm going to plug in 6.2 Cape Town. Why? Because we're looking at the City of Cape Town, right? So I'm going to put in here appreciation 6.2. That's year on year, how much properties appreciate. I mean, there's a lot. You can look at sectional titles versus not. You can look at new builds or not. I'm not going to go through all of that. Like I said, I'm just waiting for my coffee machine to finish so that I can make a kofa and then work. Now I've got rental growth at 6%. I'm also going to put it at 6.2 because if what's the name is appreciating, property is appreciating at 6.2, you'd like to think that that's also what the agent is going to put, or the owner is going to tell the agent to put up. Look, if you don't agree with that, please let me know in the comments. I mean, I do this for my personal portfolio. So for me, those numbers work hand in hand. But if there's something I'm missing, you know more than me. Like if this is your industry, if this is your jam, you hit me up. Tell me, Tando, you're in the wrong. and I would happily like revise whatever I'm doing, whatever I'm saying, because I want this model to be successful. Right. We're going to do a 20-year bond term. We're going to keep it clean. I mean, you can do 30, you can do 25, but often that has to be up to you. But if the bank offers you 20 or 25 or 25 or 30, it's an affordability issue, and maybe you should step back from the investment. We'll talk about investment here. Hey, we're not being emotional. It's either I get in or I don't. You understand what I mean? It's not a personal home whereby it's not a spreadsheet exercise. It's a I like the kitchen exercise. I love the bathroom. Oh my word! Look at that balcony. It's a different hat that we're wearing today. Inflation on levies, I think 9 is a bit high, but that's what I've experienced in Joburg. Inflation on rates, I think 9 is a bit high, but that's what I've experienced in Joburg, so I'm going to keep it there for the purposes of this exercise. Inflation on building insurance, I don't know, but because I put in inflation on levies, it should cover it, because remember, we're dealing with the sectional title, so the levies, the body corporate, you pay the body corporate insures your property or your unit on your behalf. So this is a variable, and then it's basically saying over a 20-year hold, the property that you're going to be offering 1.3 million at, 90% of the discount, which is worth 1.45 at the time, is going to be sold at 4.9 million in 20 years' time. So that's quite fascinating to look at. I'm putting May as the date of investment. That's next month. That doesn't matter. Right. So it's showing the bond as 13.4, right? That's your bond. Your rental amount is 13,000. You've got all of these other costs. Already you're in the negative. That time you put in a very little, like a very low, what's the name? But you didn't put in a deposit. You put in a low offer relative to how popular this area is. Let me put it at that. For Stats SA, what I could do on rental growth, I could put in the inflation number for Cape Town, but I don't really want to do all of that work. That's also on Stats SA, that's also available at a provincial, I don't know if it's at a city level or a metro level. So I'm comfortable with these numbers as they are for the moment. So this is what you're getting as in return. I'm going to show the charts, but it's basically saying if you hold it for 20 years, we're going to assume you're not buying cash because, yeah, this is the cash purchase. It's obviously negative with the transfer fees and costs that you're going to pay initially. But over the term, it's obviously cash flow positive, and then that's when you exit. But we're going to assume we're bonding it, right? We're bond investors. I do apologize. I know my chart doesn't look the greatest. I'm just going to try and make this a bit smaller. So what we're basically seeing here is that it's cash flow negative until the end of time. So in year one, it's obviously the 81K, which is the initial outflow that you pay out. Sorry, that's in year 0. So it's that 81,000, the transfer fees that you're going to pay out. Why is this 138? C31 D30. Oh, okay, it's 1.3 million. Sorry, I wasn't seeing that. So it's this sum because you're buying cash. I thought I was getting that wrong. Yeah, it's 1.4 million because you're buying cash, so everything comes out. Okay, that's fine. So on this side, I'm not happy with my axes. Can you guys tell me how I can make this big so that I can see more of this without this looking weird? Because that's obviously what's throwing off the scale. But the investment is negative in year one with the initial cost that you pay out. In year two, it's negative. That's about 5,000 a month. Oh, that's a lot of money. Year two, it's also about 5K a month. Then in year 5, it's about maybe 4K a month. Year 10, it's about 3K a month. 15, yeah. Let's do a shorter holding period. I'm not going to do the whole goal seek thing. I'm just going to halve it and see what that does. So obviously, you saw this shot down because you're holding it for less at the same, appreciation rate, which is about 6.2%. It's got less years to actually appreciate. That's basically it. What you tend to see on the unleveraged return is you're making 13% of your money and that's the return multiple. There's something I forgot to say. So the discount rate. So let me actually tell you how I got that. So I got the discount rate by going or Googling F&B money market rates. Then you say, let me just do it. Click here, savings and invest. Then here you go to rates and pricing, save and invest. What I'm basically trying to show you is how much interest you're foregoing by paying for this property. So it's a bit tricky because you can do the initial 81,000 or you can do the monthly 13,000. I don't have a calculation that does both. So what I tend to do is I just do the monthly bond payment, because that is a longer term investment, and that's where you're missing out on the compounding interest type of thing versus the initial cash flow at the beginning. So I'm more interested in that. So I'm going to click on access immediately, which is money that's readily available because it's the lowest. So that's what you want to use. So if the bond is 13,000, this is what you want to use, the bracket. So I'm going to use the effective rate of 6.33%, and that's what I'm going to put in as my interest that you're foregoing by investing in this. So 6.33, so lower than the 6.5, right? So that's the discount rate. I put it here as opportunity cost / required rate. So this 13% is above the 6.33. What I'm basically saying there is the 13,500 that you're paying in the bond, right? Obviously there are other fees or other costs, like you're going to pay the levies, you're going to pay the rates, those are, the allowance for bad debts is a reserve. So, but I'm basically saying this 15,000, if you were to invest it with F&B's money market, you would be getting 6.33. If you invested in this project, let's think of it as a project. If you invest in this project, you're getting a return of 13.6. 13.6 is bigger than 6.33. So, but it's not cash positive, right? We can see you're never going to be cash positive. So where are you making your money? You're making your money from the appreciation. That's it. Which is what you're seeing here, the 452,000. That's the big money. That's the money that you get after you've paid your agent, after you've paid your agent. So that's how much money you would make out of this investment, right? That's the idea behind this sort of series that I want to do. I want to do multiple of these, and then I want to share them. Hopefully the videos are going to be like nice and short. I'm hoping for engagement because I can only get better if there's communication. I'm just quickly going to take you through where I got everything again. I got the property listing from Property 24. I got the rates from F&B's money market rates. I went here, then I said rates and pricing, then I said save and invest, and then I said access immediately. That's where I got the rates, and then I got the publication on the growth. I got from Stats SA, that's the residential property price index. Like I said, it speaks to October 2024, but it's published in March because there's a 6-month lag. So now in April, we're going to get the November 2024 numbers. There's a lot of insights here. I know they speak about, I think, new builds, which is always quite interesting. Maybe they don't call them new builds. Okay, that's freehold properties. That's sectional, resold or existing, sold for the first time. So these are new builds, right? So new builds in City of Joburg are doing very well. They're appreciating at 5.3%. City of Cape Town, they're appreciating at 4%. Nelson Mandela Bay at 4.4%. At Buffalo City, they're not doing well in new builds. That's resold. And then sectional title, maybe we should have used the 4.3 rather, but it's okay. Here in Cape Town rather than the 6.2. And then freehold is standalones. They're increasing a bit more at 7% here. In Jozi, they're not doing too well. And then at Buffalo City, they're doing very well. Nelson Mandela Bay. And that is essentially it. This is free. Just go to StatsSA and, gain that access. Look, I'm excited about the project. I'm excited about, Excel has crashed. Excel always crashes. Like I said, I'm excited about the project. I'm excited about doing a lot of these, but it's obviously properties that I'm going to be interested in. If you do have properties that you want me to look up, maybe send the web reference number, but it has to be Property 24. and then I can look those up and maybe I can feature them on the show. I'm gonna try and do this often, but obviously time is currency and I might not get to it. And yeah, I'm gonna end the video here. I hope this was helpful. Share, like, subscribe. What do you guys think about the 1.4 million rand apartment at Claremont? If I like it, it's spreadsheet, Sam. But let me know what you think, and then yeah,